Yo, 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 it's your boy, the insurance junkie, your fiduciary fella, the all-star advisor Alonzo Hall, and I've returned today with another ADH Wealth Solution. Today, we'll begin to discuss fulfilling all of your financial needs. To contribute to channel growth, the links are in the description. To schedule an appointment of your own, or to purchase life insurance directly up to $1 million with no medical exam and an instant decision, my information is in the description. Lastly, make sure you hit that like, drop a comment, subscribe, and hit that notification bell so you're made aware every time I release new content. And as always, share, share, share. And now, here's our next feature.
Hope everybody can see this screen here. So I'm gonna head over to this page. I mentioned that the stock market has volatility, and that kid who's over at the end of the ice skating line, he or she is moving around a lot around the ice. And that's the volatility. It's a little bit more risky than the bond. What this chart here shows is that over the last 41 years, it's a pretty long time, the S&P 500, which is how we sort of refer to the US stock market, the 500 largest stocks that are available and that are publicly traded, on average, in the middle of a year, the S&P 500 has declined at one point or another 14% on average throughout those years. That's a pretty big decline. You know, if we're starting with $100,000 and you invest the day before the stock market starts to decline that year, that means on average, it's gonna fall to $86,000. However, when we are patient and we stay the course and we don't invest emotionally, what this also says is that the average rate of return is over 10% a year. So if you invest and you stomach those 14% declines down, you're gonna get 10% a year on average when you look at it for a wider period of time. So the red dots on this chart represent how far the S&P 500, the stock market, dropped in that given year. And the blue bars or black bars here represent your total return that year. So that's why it's important to know exactly what we're investing in. If we find that we are quite emotional, you know, data suggests that it feels better to not lose money than it does to make money. So think about that for a second. It feels worse losing money than it does feel good making money. And so when we take this into account, you know, that's why I'm not much of a gambler. That's why if I ever go to Vegas or Atlantic City, I'll pull out $20 just for fun, because I know that I really hate losing money for dumb reasons. And so I use that's my personal investor personality. I use that to build my personal asset allocation. So I know that I might get emotional in the short run if the stock market were to drop 20%. So what I do is I blend stocks and bonds for how I feel good. I feel good right around 70-30, 70% in stocks, 30% in bonds. That way, if the market drops 10%, I'm probably only dropping 6 or 7%. I can withstand that. I can feel good doing that. The next page I want to show you is how important it is to be invested in stocks. I mentioned inflation. It's also important to earn a good rate of return. You know, the amount of money that we could talk about building generational wealth, it does come through home ownership, but it also comes through capital markets. And so when we put money up for risk, it's important not only to risk it in the bond market and not only buy bonds that are paying 2 or 3% a year, because as you'll see here by the gray line, which is inflation. So inflation moves up and to the right. And then above that, we have bonds, United States Treasury bills. That's the yellow line. It just kind of stays, constant with inflation. So what are we really doing? You're putting your money up at risk, and all you're doing is, at the end of the day, coming away with the same return of inflation. So the other lines the top two lines represent US stocks, smaller companies and bigger companies. And you'll see how much wealth is created over a long period of time. So it's important to make sure you have some money in stocks, not necessarily for everyone. It is by what phase of life you're in, but it's important to have some representation there and to work with an advisor to figure out what's the right blend for you. Over here, we'll talk about the average investor in red. I mentioned how we can get emotional and behavioral investing. So the average investor in red earns about 2 or 3% a year when they invest. And that's because we like to buy high and sell low. But that doesn't make any sense. We put money to work when the market's going up, and we tend to sell when things are really bad. We want to do the opposite. The name of the game is to buy low and sell high. So when you are working with an advisor, they help prevent you from selling at the wrong time and buying at the wrong time. Although, as you'll see here, we can't really determine when is the exact right time to buy, but we can determine that we need to be in for a certain amount of time. As you go from left to right on this screen, you'll see a 1-year return at the bottom, a 5-year return, a 10-year return, and a 20-year return. The band of returns gets considerably more predictable as you go out to the right in a longer period of time. The blue represents just being in stocks. The teal, I'll call it, represents just being in bonds. And the gray represents being 50-50, half in stocks, half in bonds. So, these, I want to be conscious of our time here. I think I'm coming up to the end of my time, but I just want to I want to make sure that we're sure of 3 things. Asset allocation, knowing what a stock and a bond is, and making sure that you have the right allocation. Being patient and making sure that we don't invest emotionally, and if we need to, working with a professional. Happy to answer any questions afterwards. Thank you.
Hey folks, this last video was sponsored by my company, where we help people like you to reach their financial goals. We do this through a simple conversation where we help to identify and then protect your lifestyle, and then we implement a plan. The process starts at about an hour. So, if you want more information, or you want to schedule a consult, contact me via the information in the description box, and let's talk and see if we're actually a great fit for each other. And remember, ladies and gentlemen, when people challenge you, they don't challenge you to challenge you, but they challenge you to challenge you. Accept the challenge. Thank you, and enjoy life.